Good morning. My name is Walter Szymanski. I am from Everingham and Kerr. We are lower middle market M&A advisors, and I am here this morning with Robert Schwartz, attorney at Lindabury, McCormick, Estabrook, and Cooper. And we are going to be discussing today the process of closely held business merger and acquisitions, including corporate limited liability company, or LLC, and owner taxation. A little bit about Everingham and Kerr. Everingham and Kerr was founded in 1988. We are a boutique investment bank focused on merger and acquisition services for the lower middle market. Lower middle market is a somewhat vague outline. Many people consider it anywhere up to 100 million. We work with clientele that are doing less than $1 million in revenue up to $100+ million in revenue, with a sweet spot of $2 to $50 million. E&K assists clients across many different industries. We are primarily a sell-side firm and we do some buy side. Our client base is majority private companies. We have done some public work. We work with investor groups, individual entrepreneurs, PE firms, management buyout, and family buyout participants. We have been in business for almost 30 years. This year we will complete our 500th transaction, and the professionals at E&K have over 140 years combined experience. With that, I would like to turn the mic over to Bob Schwartz to talk about Lindabury.
Thank you, Walter. Lindabury, McCormick, Estabrook, and Cooper was founded in 1954. We have a 63-year history. We're a general practice law firm principally located in Westfield, New Jersey, with a substantial corporate, estate and trust, tax, employment, construction, and environmental law practices. Over the last 63 years, we've represented buyers and sellers in hundreds of mergers and acquisition transactions. Today, we have experienced lawyers in all aspects of mergers and acquisitions, but since we're a law firm consisting of approximately 50 lawyers, we do not have layers of attorneys assigned to M&A transaction work. Our practice area consists of the states of New Jersey, New York, and the Commonwealth of Pennsylvania. We've served clients across virtually all industries, and we've had experience with strategic buyers, private equity buyers, management buyout groups, family buyout situations, and we've worked in the past with companies like Everingham and Kerr, to whom we've recently developed a relationship that we hope will continue to the benefit of both firms' clients.
Thank you, Bob. To understand the process of buying or selling a business and the importance of having a qualified law firm at your side, whether it's through the negotiations or understanding the tax implications of a sale or a purchase, I'll explain a little bit more about E&K and what we do. Through valuing and selling a privately held business, the first, as I explained the introduction to Everingham and Kerr and who we are, we will go through the sale process and then also discuss a little bit about our buy-side programs that we have, as well as our valuation program and experience, and certain things clients can look at as value enhancers to make their company look a little bit better to the general market, and obviously increase the multiple that companies are willing to pay for them. and then I will touch on current market conditions that we are seeing right now. As I explained a little bit earlier, Everingham and Kerr focuses on the lower middle market, and that was really brought about by Bob Everingham back in 1988, when we saw that small companies, boutiques, what you might call mom and pop stores, things of that nature, they were well serviced by business brokers who could sign up clients, put them up onto websites, and it became more of a reactive process where people called in and asked for information on a company. Usually there's a purchase price, request price on those flyers and internet announcements that are out there. Then you had the larger firms that dealt with the companies doing $100 million, $75 million and above, and those typical M&A houses and investment banks. They're left a void for the business owner doing $3 million, $10 million, $15 million, and the larger firms did not want to get that involved with it, and the business broker, it really wasn't their specialty. That was the concept behind Everingham and Kerr, was to cater to that clientele. We, as I mentioned earlier, focus more on the sell side. That would be business owners looking to sell their companies. That's about 70% of our business. Companies looking to buy other firms, we have a program where we go out and seek investments for them, and that's about 20% of what we do. We also offer valuation services. Both of the principals of our firm are certified valuation analysts. We do work for banks with regard to independent valuations for SBA loans. We work with attorneys for various reasons, such as divorce. We also work with CPAs and wealth management companies for valuations. And we also do some transaction consulting. Much of that is done on an hourly basis, and that could be if there was a process already in place and two sides negotiating a deal, but they needed a little more help in the middle to get the deal to the finish line. And we are available to do that as well. For a company that is looking to sell, the process starts with, once a client is signed up, we sit down with the client. We want to make sure that we understand the seller's objectives. It's not always, and very rarely is it just about money. It's about quality of life. It's about, what am I going to do after this? Many clients want to sell their business, but they don't want to cut the cord immediately. They would like to stay involved. This is, for many business owners, this was their baby. They grew it. It could be their grandfather started it. So they would like to make sure that it continues forward, or they don't have something planned moving forward and would still like to stay active. It is very important for us as a firm to understand that, so that we can target and put together the proper prospects to work with the seller in order to reach that ultimate goal of the way that they want this process to happen. We go through and explain the process. The process is gathering a lot of information on our side: financials, the marketing information, the structure of the company, the key employees, and so forth. And from all of that information and all that documented info that we get, we put together a offering memorandum. We call it a confidential business review, or a CBR. With that information, we also include a normalized view and picture of the company from a financial view. It'll include any add backs, depreciation, and so forth, to show the true value of the company on a year-over-year basis, as well as a normalized balance sheet. That is critical information for anybody looking to buy a firm, and that will be part of the CBR. From all this information and the CBR, we then put together a blind teaser that will be launched out to the general public. That blind teaser typically will not have the name of the company on it. It will not have an asking price. We never put an asking price on a firm, as we believe that ultimately the market is going to dictate what the value of the business is. And we don't want to put numbers in people's heads, whether it be on the low side or the high side. Every buyer has a different value for a firm based on what they want to do with it in the future. So it's critical that we leave that door open for any negotiations and talks. When we launch out to the public, it is that blind teaser. It might say New Jersey, it might say Mid-Atlantic region, it might say somewhere in the eastern part of the U.S. That is all to protect our client so that nobody knows who the company is until they sign an NDA and receive the CBR. Our launch is inclusive of professionals across many industries. We will send this email to over 40,000 attorneys, 20, 30,000 CPAs, bankers, wealth management people, private equity firms, as well as developing a strategic list of companies that might be interested in this possible target. And we send them all the information on that teaser with the attached NDA that if they would like more information, please send it back to us and we will provide the book for our client. From that, we will get a list of signed NDAs executed. We will narrow down. We will ask companies to give us a basic indication of value, just a rough idea from the information you've seen what you think this company might be worth. Usually that'll weed down, it could be 5 companies, it could be 15 companies. We then will set up meetings with management so that the prospective buyer can come see the firm, or it might be a phone call conversation if they don't feel that person to person is important. And from that, the leading prospects, we will ask for a full indication of value, a letter of intent. And with that, that will state what they're looking to pay for the company, the terms they're looking for, whether or not it's going to be an all cash deal, whether it's going to have a piece of maybe an SBA loan in place with it, or they're asking for a seller's note. We put all the different offers together and sit down with our client to see which one works best for them, and we will choose a candidate to go with. That next part will then move into the negotiations. And sitting down with the negotiations, at this point, we are looking at what works best with the client. And at that point, really the attorney gets much more involved, because that floats right into the due diligence. This is where both sides are going to start digging down on each other, and questions as to the way that the contract is written, the offer that's being presented, what type of tax implications does it have on the seller and the buyer, and that's really a lot of negotiations to make sure that both sides come up with something that is acceptable to them. Having a qualified law firm at your side that has done this before, understands the importance of knowing the tax laws and what is acceptable is very, very important to both the seller and the buyer. From that part, we will then carry through and work making sure that the emails are going through and the closing date, and we are there for our client for any questions they may have that don't pertain to the legal part of it, but just the overall what ifs. And so it's more of a consulting portion right there. Part of our job, we like to consider that we are also psychiatrists for this process, because it is an emotional process. Moving forward from the sell side, the buy side is similar. I'm really only going to touch on the first part here, the strategy. It's understanding what our buyer is looking for, how much they're looking for. Are they looking for a strategic fit? Are they looking possibly for a hedge to their company or something they can tie in or expand into other markets? From there, we will do a complete search and contact for firms that fit using our internal database of well over 500,000 companies and individuals, as well as paid services that we use to find lists. We send out mailings to the presidents of all these companies, and we follow up with calls to all of them. Let them know that this is a legitimate search, that we have been attained by our client and our fees are paid by our client. We are not sending out a letter saying we know a company that wants a business just like yours. Anytime you receive a letter from us stating that we have a client, there is an actual paid client behind it, and we will openly tell you who that is. That is very important in the beginning of any transactions so that you establish trust in each other. Moving forward, it goes through many of the other processes of setting together introductory meetings and negotiations, and then the due diligence and the closing is similar to that of a sell-side engagement. It's just the reverse. Valuations. Like I said, we do evaluations for estate planning, buyout, management, one partner over another, and employees, ESOPs, third-party sales, other acquisitions, bank valuations. Like I said, many times it comes through for SBA loans where banks need an independent valuation. Value enhancers. When we first sit down with a client, what we look for and what we like to discuss with them is seeing what their company is, understanding their company. Is there a strong, stable management team? And these are all things that any potential buyer wants to see. Some people do look for distressed companies that are in turmoil, but most people want the transaction to go smooth and for the company to be up and running and profitable right off the bat. So sellers, as you are leading up to that time and thinking about, I want to sell my company next year, I want to sell it 3 years from now, or maybe you want to sell it next month, look inside your own company. Do you have strong, stable management team? Have you demonstrated positive cash flow? Are there things that you can do to better your cash flow for the company? What is your historical growth? And do you have a strategy for moving forward? Are there markets you could get into? Are you showing a nice upward trend in your growth? Is your customer base diversified? We recently were working with a client who had one large customer. That customer decided they were not going to move forward with them anymore, and that trashed any type of a deal that might go forward in the meantime until they can spread out and not be so focused. That is very important for buyers, that when they come in, that the business does not rely on one company. Are you in a niche business? Do you have the ability to expand out of that? Accounting and reliable records are very important. Whether it's the attorneys coming in or the buyer's CPA, they want to be able to see all the credits and debits. They want to be able to see where the money goes. Is it being spent wisely? Are there any concerns out there? With that, you can also say being open and honest. If you have possible litigation coming up, put it on the table up front. It's not a deal breaker. As long as the information is out there, almost anything can be worked through. It's when information is being hid that it becomes a problem later on, because that trust factor disappears. Contingent liabilities, again, we don't want to have any out there. If anything like that is out there, it's better to have it on the table, whether it's speaking with us as the advisor or your other advisors, attorneys, CPAs. It needs to be disclosed and open so that some kind of discussion can happen to possibly work through it. Proper professional representation, as I mentioned earlier, having a law firm working with you that has done this before, that understands the process, that understands that it's not my side wins over your side. It's about both sides working together to get to the finish line where both sides are either happy or, quite honestly, both sides aren't perfectly happy. That's usually equals a good deal. Do you have patented products? Understanding the patents on them, the life of them, having an idea of the value of those is very important, and well-maintained facilities. Just like when somebody's selling a house. When you get ready to sell your house, you don't have an open house to the laundry on the floor and the dishes in the sink. You stage your house. You make it look as good as possible, as clean as possible. You want to impress potential buyers. The exact same theory works when you're selling your business. You want it to look presentable to anybody that comes in and looks around. Lastly, discuss the current market conditions that we're at right now. Obviously, we have a newly elected president who is pushing a pro-growth, pro-business platform that has many people excited. Because what it does is we're looking at lower capital gains. Lower capital gains creates more cash flow for businesses and for individuals to go out and invest. Interest rates are still very low right now. They are beginning to increase. However, they're still low. As interest rates increase and continue to move up, that's going to make cost of capital higher. That's going to decrease the number of buyers out there. There are private equity funds out there that are flush with funds. They are both the large firms and the smaller investment groups have tremendous amount of investors behind them looking to buy into this economy and this surge in growth. That creates a lot of buyers out there, and it is the perfect time to look at selling your company. The economy is improving. We've been on a nice upward trend for a while. You don't know if it's going to be another year, 3 years, or 5 years. Most of that has to do with the items that are above, looking at interest rates, capital gains, the agenda of the president and how he's able to get things through Congress and what it means for businesses. Financing. Financing has become much easier over the past couple of years. Banks are looking to lend money. Banks are looking to get into this growth. So the last part comes down to good time or bad. And that really is an internal look on the business owner. Is it the right time for you? Yes, maybe the economic trends say it's the right time. Maybe this is the best multiples you're going to see. It's the best multiples in the best market that we've seen for selling a business in 30 years. That doesn't mean it's the right time for you. That is really the very first thing that you have to understand as a business owner is, am I okay with it? Can I go to bed at night? Is this the right decision? If it is the right decision for you, your family, your corporation, then you move forward to the next step. If you're not sure, but you think it's just a good time because you're going to get a lot of money for your company, you need to look a little bit closer inside and make sure, because at the end of the day, you need to be comfortable with your decision. So that is the end of our presentation, and I will turn the microphone over to Bob now.
Thank you, Walter. Walter mentioned in his review of the business sale and purchase process buyers coming forward with a letter of intent to buy the business. A buyer's letter of intent, or alternatively at times there is instead a term sheet, can be changed in further negotiations to better reflect a prospective business seller's tax structure. After tax sale proceeds to sellers are often paramount. On the other hand, a buyer's desire for deducting the sale price can cut against this seller's paramount objective. A prospective seller's sale proceeds after income taxes depends upon the type of legal entity or entities through which the business has been historically operated. Under current federal tax law, if the entity is a corporate income tax payer, commonly known as a C corporation, the difference between the sale proceeds and the tax depreciated and amortized cost base of the corporation's business assets is subject to the 35% federal corporate income tax. For example, if the sale proceeds are $10 million and the business assets cost base is $2 million, the after federal corporate tax proceeds to the corporation are $7.2 million. If the business is conducted in New York, New Jersey, or Pennsylvania, after state corporate taxes, the proceeds are roughly $6.8 million on a $10 million sale. Ordinarily, a C corporation business asset sale leads to a liquidation and dissolution of the C corporation. Assuming, in my example, $6.8 million after federal and state corporate income tax is distributed to shareholders, the federal capital gains tax of 24% leaves after-tax sale proceeds of approximately $5,168,000. Looking at New York, New Jersey, or Pennsylvania as states of shareholder residence, the effective income tax rates on the corporate liquidation proceeds are roughly 6%, 6%, and 2% respectively of the $5,168,000 received. C corporation liquidating distributions often can be put off until a later year, thereby deferring shareholder federal and state taxation and possibly avoiding these states' income taxes through residency changes. By contrast to the C corporation business asset sale, if C corporation stock is sold, for example, for $10 million, then even assuming a zero cost base in the stock compared to the $2 million corporate asset cost base in my earlier example, after federal income tax, the proceeds to the selling shareholders are approximately $7,600,000, contrasted to $5,168,000 in the asset sale scenario. Stock sales are also subject to state personal income taxes as well. A seller who establishes residency in a state such as Florida in a sufficient time and before the year of closing pays no state income tax on stock sale proceeds. Looking at the buyer side of the C corporation seller business entity, most often, not always, prospective buyers prefer to buy the assets of a business because Internal Revenue Code sections provide for what is effectively a straight line income tax deduction of the purchase price over a maximum of 15 years. Many prospective buyers calculate their internal rates of return on investment, and in doing so, they factor this deductibility into their pricing offers. A comparative analysis of seller tax cost and buyer tax savings sometimes leads to a lower price for a stock sale than for an asset sale. But ironically, the seller has more after tax than if C Corporation assets were sold. Returning to my example, if the price for stock is $8 million rather than a price for assets at $10 million, the seller keeps $6,080,000 after tax compared to $5,168,000 in the corporate asset sale scenario. A firm such as Everingham and Kerr may, in a particular engagement, have had the opportunity to think through these implications, and they're reflected in what amounts to a mutually signed letter of intent before the buyer and seller proceed to definitive contract negotiations. Other times, because of the dynamic of the purchase and sale, including the relative sophistication of the seller and the buyer, the quality of their accounting and legal representation, and other factors, this kind of tax analysis may not come into the picture until after a term sheet is initialed or a mutual letter of intent signed, reflecting a purchase price not taking into account the after-tax ramifications of the transaction. I'd like to proceed now to the scenario where the seller's business enterprise is operated through an S corporation. S corporations are not subject to the corporate income tax, federal or state. Provided, however, S corporation status has been in existence for a full 5 years prior to a closing. If the seller business is conducted through an S corporation that has been an S corporation for at least 5 full years pre-closing, the business sale will occur below the highest level of income taxation present in the case of a sale of C corporation business assets. Returning to my example, the $8 million of corporate asset sale gain is taxed only once in the case of an S corporation seller and at the shareholder level for the year of sale and at a blended federal tax rate as between the federal 40% ordinary income tax rate and a 24% capital gains rate. If there is little in the way of depreciated tangible assets being sold, little of the corporate asset sale gain is subject to the 40% rate, and the more favorable 24% capital gains rate predominates in the blended rate calculation. If, on the other hand, the business involves a great deal of depreciated assets, such as considerable plant, property, and equipment that maintains a relatively high market value, the ordinary income component is going to be higher relative to the capital gains component. When we return to a $10 million corporate asset sale generating $8 million of taxable gain, assuming a shareholder blended federal income tax rate of 27%, S corporation shareholders keep a much higher $7,360,000 post-corporate liquidation than the $5,168,000 kept with a C corporation asset sale. Meanwhile, with the S corporation asset sale, the purchaser obtains the benefit of up to 15-year straight-line tax deductions for the sale price. For one or more non-tax reasons, such as non-assignable contracts and licenses, the structure of the transaction often must be the shareholder's sale of their S corporation stock. The buyer will usually want to make an Internal Revenue Code Section 338H10 election because the election transforms what is a stock sale for all other legal purposes into a corporate asset sale for federal and state tax purposes. Often, the selling shareholders have no after-tax reasons not to agree to the election. Sometimes, however, the seller's posture necessitates that for tax reasons, the S corporation adopt a plan of dissolution and liquidate the sale proceeds during the same year as the sale closes. Time constraints on closing and liquidating the corporation during the same year can make necessary a corporate liquidating trust. The classic situation where this arises is if a major shareholder recently died, with the consequence his stock cost base is increased to its fair market value as of the date of death, which is a cost base approaching the offered stock sale price. A stock sale with the 338 election would leave the sellers with less after-tax proceeds unless a properly planned liquidating transaction structure is effectuated in the same year as the closing date. If it looks as though that's entirely impossible, the seller may bargain for no buyer Section 338H10 election, which may in turn affect the offering price. I mentioned earlier that S corporations that have been such for at least 5 full years at the time of closing are, in effect, tax-efficient selling vehicles. However, an S corporation that has not had its S status in effect for 5 full years at the time of closing, known among tax attorneys and corporate attorneys as S corporations with built-in gains, there occurs in the sale of assets of such corporations very high income taxation. Returning to my example, in the case of the sale of business assets of an S corporation with built-in gains, the 35% corporate tax rate is imposed on the $8 million of gain during the same tax year that the shareholders are also taxed on the gain at the blended 40% ordinary income, 24% capital gain rate, which depends upon the composition of the corporation assets sold. This circumstance is known as a built-in gains problem. By contrast, the sale of an S corporation with built-in gains, the sale of the stock of such a corporation, and without a 338H10 election, escapes the simultaneous taxation of the shareholders at the 35% corporate rate and the blended 40%, 24% capital gains rate. Emerging federal income tax reduction is an important consideration at this time in the context of C corporation and S corporation business sales. Assuming federal tax law changes include a significant reduction in the federal corporate income tax rate from the current 35% to a 20% corporate tax rate, then the after-tax proceeds of a corporate asset sale by a C corporation or an S corporation with a built-in gains problem is going to be materially better for the seller. Further, federal tax changes may involve a reduction in the current 40% ordinary income rate to a 35% rate, in which case a blended taxable rate to shareholders would consist of a 35% rate, and also there has already been passed by the House of Representatives a reduction in the capital gains rate from 24% to 20%. At these lower tax rates, federal tax savings to the seller of businesses operating in a corporate form are material. Limited liability company sales. If the business is conducted through a limited liability company, the sale of member interest results in capital gain taxation to the sellers, except if and to the extent the business possesses substantially appreciated inventory and accounts receivable at the time of closing. To the extent of these assets, an apportioned amount of the member interest sale gain is taxed at ordinary income tax rates. Ordinarily, however, the sale of interests in a limited liability company skews the blended rate toward the 24% capital gains rate, or in event of federal tax reduction, a 20% rate. Unlike in the case of C corporations and S corporations, if and to the extent the limited liability company has borrowed repayment obligations at the time of the sale of member interests, the unpaid borrowing is considered additional taxable sale proceeds. This rule is inapplicable to C or S corporation stock sales. However, it is not necessarily a tax detriment, because ordinarily under subchapter K of the Internal Revenue Code, such company borrowing increases member interest cost base, unlike with borrowings by corporations, which do not affect shareholder stock base, even when the borrowing by the corporation is guaranteed by shareholders. On the buyer side, a buyer ordinarily makes an Internal Revenue Code Section 754 election to step up the cost base of the company's assets to the purchase price, including the company's borrowing repayment obligations at the time of closing. The tax benefit to the buyer is the income tax deduction of the purchase price over a maximum of 15 years, the same as in the case of the Section 338H10 election in the corporate stock purchase and sale context. Unlike with the Section 338 election in that context, however, a Section 754 election does not cause the sale of the membership interest to be treated as a sale of the company's assets, as that would affect the seller's income taxation. If the form of the business purchase and sale transaction is a limited liability company selling its assets, the buyer similarly obtains up to 15-year straight-line tax deductions for the purchase price. In the case of a limited liability company asset sale, the sale amount realized to the company owners also includes the company's borrowings that are assumed or the assets are taken subject to by the buyer. The company members ordinarily have blended ordinary income and capital gains rates on a sale of a limited liability company's business assets. Ordinarily, the blended rate is skewed toward the 24% capital gains rate as opposed to the 40% ordinary income rate. The same is with the sale of the assets of an S corporation. On the other hand, it may be skewed more toward the ordinary income rate, again in the circumstance where the selling business has considerable plant property and equipment that has been depreciated for tax purposes but maintains a relatively high value. There can be a difference between the seller's blended tax rates, that is to say, their effective tax rate, between a sale of member interests and a sale of limited liability company assets. On the one hand, for example, seller accounts receivable may not be sold in a limited liability company asset sale, whereas they would necessarily come along with the purchase of the limited liability company member interests. I've covered tax transaction effects of a business purchase and sale, and I now like to turn to further due diligence considerations. Due diligence considerations are reflected in a number of important sale agreement provisions. After all due diligence related matters are negotiated and documented, last occurring is the closing and then post-closing matters. Because rarely do courts make a more favorable business sale agreement for the buyer of a business, but instead base their rulings on the basis of what the sale agreement states. Buyers require sellers to make many representations and warranties concerning the status of the business as of the time of closing. Each one has as its purpose ferreting out any and all potentially costly matters occurring pre-closing but not coming to light until after closing. As Walter mentioned, these kinds of circumstances are best disclosed to buyers early in the process of negotiating a purchase price. However, in that context, it's not always possible for business owners and key executives to recall or remember all the potential problems that may be inherent in operating the business, of which they may not be aware and which have not come to light in any form, no matter how slight. The following is a typical list of representation and warranty topics as to which sellers are expected to state the matters concerning them are true, correct, and complete. However, sellers can specifically disclose exceptions, such as known or suspected problem areas. Ordinarily, as Walter mentioned, the proposed sale price will not change. At the same time, sellers protect themselves from post-closing buyer lawsuits alleging agreement breaches for which buyers have resort to monetary damages. Common representation and warranty topics: that the seller entity is duly organized and validly existing, that the named shareholders are in fact the only shareholders, that the selling shareholders each owns free and clear a precise number of shares. This is the case whether it's an asset sale or a stock sale. That the selling business owns its business properties free and clear, or has valid leasehold interests in rented real estate or leased personal property. The fact that the signing and performance of the sale agreement will not cause a breach of any other agreement to which the selling business is a party, such as, for example, a bank loan agreement that requires lender consent to sell. That the financial statements of the selling business present fairly in all material respects its financial condition. That there are no current or threatened lawsuits against the selling business. That the business tax returns have been timely filed and are true, correct, and complete in all material respects, and that all taxes shown as due on the returns have been paid or provided for. That the current list of customers is accurate, and that at least as to the larger customers, there is no reason for the sellers to know those customers intend to terminate the relationships. In the particular business industry in question, that there are no environmental hazards or potential hazards. Many other particular topics, such as liability under a multi-employer welfare benefit plan, proprietary rights and intangible assets, such as know-how for processes, and other business-specific matters, will similarly be addressed by prospective buyers based upon their knowledge of the industry, their experience with earlier due diligence matters, and the input from their corporate attorneys concerning areas of concern in purchasing the buyer's business. Business sale agreements are importantly further negotiated in respect of the following considerations. Buyers do not look forward to bringing lawsuits alleging seller contract breaches of one or more representations and warranties. Consequently, while not in place of a lawsuit, but to hopefully avoid it, sale agreements typically provide that the selling entity, and sometimes its owners individually, or the owners themselves in the case of a stock or membership interest sale, agree to indemnify the buyer in the event one or more undisclosed problems covered by one or more of the representation and warranty topics had in fact occurred prior to closing, but did not come to light until after the closing. Indemnity clauses are written so as to not ordinarily require the buyer to file a lawsuit to collect or claw back some of the sale price from the sellers. Rather, they provide for some reasonable amount of money to compensate the buyer for the undisclosed monetary loss that is realized post-closing. Most often, the parties will negotiate around the following three limitations on indemnification. Assume a $20 million offered price. A monetary floor of loss amount, such as $500,000, under which floor the buyer is not entitled to seller indemnification, would be a common provision for this size of transaction. A monetary ceiling, such as $2 million, above which the seller is not obligated to pay indemnification, would be another example of a reasonable amount in respect of this limitation on indemnification. The third limitation on indemnification obligations by sellers or selling entities is the time or times after which no indemnification claims may be brought. Often buyers desire to withhold some of the agreed upon purchase price, otherwise payable at closing, in order to provide a fund in the event of an indemnification claim is made post-closing. The most reasonable response to this is for the withheld funds to be placed in an escrow account pursuant to the terms of an escrow agreement among the buyer, seller, and the escrow fund holder. In addition, the amount held in escrow need not be of the same magnitude as the indemnification ceiling amount. A proper escrow agreement will also have set forth the time or times for breaking of the indemnification escrow fund, which may be a series of partial releases of funds to the seller as time goes on post-closing. Often in the fine print of a proposed agreement's wording concerning representations and warranties, buyers will have agreements that will amount to hair triggers, giving rise to indemnification claims and/or buyer rights to sue for breach of contract. In situations where buyers have a highly desired business, buyer agreement language of this character is ordinarily watered down to reasonable levels. The variation on the foregoing themes of indemnification limitations, escrow funds, and hair trigger contract wording is so great that pointing out one or more particular examples will not be helpful to our listeners. The business sale agreement naturally leads to a closing of the business sale. The closing of the sale is typically a 1 or 2 day event in which the following takes place. Purchase price at closing is wired to the sellers. Any and all buyer promissory notes are signed and delivered to the sellers. Any and all collateral agreements to the transaction, such as consulting and employment agreements, leases, licenses, and other agreements, are signed by the parties. Also, various assignment instruments, bills of sale, motor vehicle license transfers, and many other documentation is signed and delivered by the buyers and sellers. Finally, buyer personnel comes into physical possession of the seller's business assets, records, and location. The final aspect of a business sale concerns post-closing matters. There may occur one or more indemnification events arising post-closing. A proper sale agreement will have provided for a procedure pursuant to which the matter can be addressed in a manner fair to both sides. This involves seller or buyer priority in interaction with the third party whose claims or threatened claims gave rise to the potentially indemnifiable event. Also, and typically, 6 to 9 months after closing, a business sale may involve one or more purchase price adjustments covered by sale agreement formulas relating to such matters as the estimated compared to the actual size of inventory as of the closing, the agreed upon realization percentage of purchased accounts receivable as of the closing compared to actual realization percentage, and similar kinds of purchase price refinements depending upon the seller's industry. If there are buyer promissory notes or other kinds of deferred payments, such as deferred consulting agreement payments or employment agreement payments, the collection of the monthly or less frequent time for payment sometimes becomes a matter of the sellers having to address with affirmative communications to the buyer or its legal counsel, and legal action in the worst case scenario. On that note, we are concluding our webinar, and thank you for tuning in.